Most people think the stock market is a machine that rewards intelligence. I do not think that is what it rewards first. I think it rewards emotional structure. It rewards the person who can look at the same red screen that terrifies everyone else and still ask the only question that matters. What is the business worth if I stop worshiping the price for 5 minutes? That is the gap between the way most people invest and the way I have invested for most of my life. You buy after a headline, you buy after a friend, sounds confident, you buy after a chart has already climbed high enough to make the news, then the stock falls. You buy because everyone tells you that this company is the future. You buy because the story sounds unstoppable. You buy because you are afraid that if you do not act now, you will miss the whole move. Then it falls again. You sell because the pain becomes louder than the thesis. You call it discipline. You call it risk control. You call it being realistic. Then after you are out, the stock recovers and goes right back up without you. That cycle is so common that people start treating it like bad luck. It is not bad luck. It is a broken operating system. The market does not keep humiliating ordinary people because it is cruel. It humiliates them because they keep renting conviction from other people instead of building their own. That is the mother line. If you remember nothing else from me, remember that most investors do not own a business thesis. They rent a mood. They rent a narrative. They rent another man's confidence for a few days, maybe a few weeks, and then they wonder why their hands shake the moment the price moves against them. My advantage was never that. I could predict every quarter, every policy shock, every war, every panic, or every fashionable industry story. My advantage was that I kept asking a different set of questions. Is the company actually making money? Is the current price reasonable relative to that earning power? Can this business still be a strong and intelligible machine a decade from now? Those questions sound almost insultingly simple. That is exactly why so many people ignore them. Human beings would rather chase something exciting and difficult than build wealth through something plain and repeatable. So let me show you the real divide. It is not sophisticated investors versus unsophisticated investors. It is not technical analysts versus value investors. It is not even professionals versus amateurs. It is owners versus spectators. If you think like an owner, the market becomes a servant. If you think like a spectator, the market becomes a casino with your emotions as the chips. When people look at my long-term record, they often focus on the number Berkshire Hathaway. Us long-run annualized gain over roughly 6 decades has been close to 20%. In the figures we have publicly reported in our letters and annual reports to an outsider. That looks like some kind of superpower. It is not. It is the accumulated result of repeatedly refusing to pay for excitement. The first mechanism you need to understand is what I call the headline delay. The news almost always arrives after the move. That sounds obvious when you say it slowly, but investors behave as if the opposite were true. They act as if a headline is an invitation to first access. It is usually a receipt. A stock does not become widely discussed because journalists saw the future before the market did. It becomes widely discussed because the price has already moved enough to attract attention, and then people reverse, engineer a story around the movement. The public sees the explanation after the market has already repriced the asset. Then the late money arrives. That late money is often the most emotional money. It is the money that says, now it feels safe. It is the money that says, I waited for confirmation. It is the money that says, if everyone is finally talking about it, then this must be real. But what looks like confirmation is often just popularity. And popularity is one of the most expensive things you can ever buy in the stock market. Think about what must happen before a television segment or a major online article calls a stock a winner. The stock usually has to rise first. The rise creates curiosity. Curiosity creates coverage. Coverage creates confidence in people who were too nervous to think independently. Then they buy. That is why so many investors feel as if they buy at the exact wrong time. They are not cursed. They are simply entering after the repricing event that created the story they trusted. I have spent most of my life trying to do the opposite. I want to buy when interest is low, not high. I want to buy when people are uncomfortable, not when they are being congratulated. I want a situation where price is weak and the business is stronger than the crowd feels at that moment. During the 2008 financial crisis, fear was not a talking point. Fear was the atmosphere. It was in the room. It was in the newspapers. It was in the faces of executives. It was in the way capital was fleeing anything that looked remotely financial. That was precisely the kind of environment in which rational capital could demand very favorable terms. When I invested in Goldman Sachs during that crisis through a rescue-style structure using preferred shares and warrants, the point was not bravado. The point was that panic had created pricing and terms that did not exist in normal times. Most investors saw a collapsing sector and concluded that the only rational response was to run. I saw the difference between temporary terror and permanent impairment. That distinction is worth fortunes. The market pays enormous rewards to the person who can tell the difference between a business problem and a mood problem. Most people cannot. Why? Because they are looking at the ticker first and the enterprise second. That brings me to the second mechanism. I call it the ticker illusion. Most people think they are investing in businesses, but behaviorally they are investing in motion. If the price is rising, they interpret the rise as evidence of quality. If the price is falling, they interpret the fall as evidence of danger. That is not analysis. That is social imitation dressed up as logic. A stock certificate is a claim on a business. A business is an economic engine. An economic engine can be evaluated. Is it generating earnings? Does it have an advantage that is hard to copy? Does it carry a balance sheet that can survive bad weather? Can it keep selling what it sells 10 years from now? Those questions are completely different from, what did the chart do this week? I never liked the idea that investing had to be made theatrical to be meaningful. A good business does not become bad because the quotation machine gets emotional for a month. A bad business does not become good because a chart goes vertical and strangers on the internet begin speaking with certainty. If a company is still making real money, still protecting its margins, still carrying reasonable debt, still serving a durable need, and still run by competent people, then a lower price can be good news for a buyer. That is the entire logic behind treating volatility as opportunity rather than as identity threat. When you only look at prices, every decline feels like an accusation. When you understand the business, a decline can look like a markdown. The third mechanism is one almost nobody respects enough. I call it the quality engine. People love hot stocks because hot stocks spare them from having to ask boring questions. But wealth is built in the boring questions. Is the company making money efficiently? What kind of return is it earning on the capital actually committed to the business? A rough number many investors like to use as a healthy reference point is 15%. Not because 15% is magical, but because a business that can earn around that level over long stretches often has something special protecting it. Maybe it is a brand, maybe it is a network, maybe it is a low cost structure that weaker competitors cannot match. Maybe it is distribution, maybe it is customer habit so deep that alternatives remain second choice for years. I have often described that protection with the image of a moat. If I own a castle and competitors can walk right through the front gate, then my economics will eventually be mediocre no matter how impressive they looked in one good year. But if I own a castle protected by a real moat, then time begins to work for me instead of against me. That is why I have loved businesses like Coca-Cola. People underestimate what it means for a company to live inside habit. A consumer does not wake up every morning and conduct a philosophical debate about every bottle he buys. He buys what is familiar, he buys what is trusted, he buys what is embedded in culture, distribution, and memory. I began buying Coca-Cola in 1988. I have held it for more than 3 decades because the logic was never built on a quarter. It was built on durable behavior. People were drinking it then. They kept drinking it through recessions, booms, inflation, elections, market crashes, and technological revolutions. That kind of continuity is worth more than 1,000 fashionable presentations about disruption. But even here, investors make a dangerous mistake. They see a high return on equity figure and assume they have found a magnificent business. Sometimes they have only found borrowed greatness. That is the fourth mechanism. The borrowed greatness trap. A business can make its numbers look strong by leaning hard on debt. A company with modest economics can sometimes show spectacular returns on shareholder capital if the true weight underneath is borrowed money. Let me put it in language nobody can misunderstand. Suppose you put the equivalent of $1 million of your own capital into a small business and earn $150,000. That is a 15% return on your own money. Fine. Now suppose instead you put in $1 million of your own money and borrow $4 million more. The business is now much larger. In good times you may earn $500,000. Suddenly your own capital appears to be earning 50%. That sounds glorious until conditions tighten. Then the interest still arrives. The obligations still arrive. The banks still arrive. The softness in revenue now lands on top of fixed commitments. That is when a strong-looking number reveals itself as fragile theater. I have seen investors hypnotized by a company earning 30% or 40% on equity, only to discover later that debt was doing much of the cosmetic work. When rates rise, that illusion often breaks all at once. This is why business analysis cannot stop at one flattering ratio. You must ask what is supporting the ratio: brand power, cost advantage, network strength, or leverage. If the answer is leverage, your margin of safety is thinner than it appears. The fifth mechanism is what I call cheap for a reason. Many people learn a few valuation ratios and then think they have acquired a weapon: price to earnings, price to book, dividend yield on paper. These are useful tools. In the hands of the impatient, they become self-deception machines. A low price to earnings ratio can mean you have found a bargain. It can also mean the company had a one-time gain that temporarily inflated profit. A business sells a building. It books a special gain. Net profit jumps for 1 year. Suddenly the stock looks absurdly cheap relative to earnings. The novice feels clever. The experienced investor asks whether the core business improved or whether accounting smoke drifted through the room for one season. That is why operating profit matters. Operating profit tells you more about the actual machine. Net profit can be flattered by events that will not repeat price. The book has its own trap. A stock can trade below book value and still be expensive in economic reality. Why? Because accounting assets are not the same thing as economically vibrant assets. A dying factory in a declining industry can sit on the books at a value that no buyer would ever pay in the real world. Used machinery in a shrinking market is not a hidden treasure, just because an accountant once assigned it a number. Cheap has context always. People get into trouble when they worship ratios without interrogating the story, creating the ratio. A bank does not trade like a software business. A mature manufacturer does not deserve the same multiple as a company with a long runway and unusually high returns on incremental capital. Valuation is not a number you memorize, it is a judgment you anchor in reality. This is one reason waiting matters so much. I knew of Apple long before I bought it in size around 2016. Knowing a company exists is not the same as understanding it. Admiring a product is not the same as understanding the economics of the ecosystem. By the time I felt I understood the machine well enough, the question became whether the business quality and the price could create a favorable equation. When that equation improved, I acted. That is another lesson the market keeps trying to teach people who refuse to hear it. Action is not intelligence. Sometimes the highest quality move is to wait with cash and clarity. Most investors are uncomfortable with waiting because doing nothing feels like irrelevance. But markets do not pay you for being busy. They pay you for being right enough, at the right size, with the right discipline. The sixth mechanism is the holdability test. This is where most fashionable stories fail. Even if a business is good and even if the price is fair, the final question remains, can it be held through time by a rational person who wants a life, not a daily emotional hostage situation? Some businesses cannot pass that test because the industry itself changes too fast. Some businesses cannot pass it because their economics are too cyclical and too tied to conditions that can reverse violently. Some businesses cannot pass it because management cannot stop reaching for the next shiny gamble. I have generally favored industries where human behavior remains durable and understandable. Consumer staples, insurance, certain financials, telecom, selected businesses with entrenched positions and enduring demand. The point is not that innovation has no value. The point is that predictability has enormous value when your game is compounding rather than excitement. Kodak is an important warning here. There was a time when the company looked strong on the usual metrics, profitable, established, seemingly durable, yet the underlying world was changing. Film economics were not the future. The business looked safe if you stared backward. It was vulnerable if you stared forward. That is a powerful distinction. A company can have a pretty report card and still live in a decaying neighborhood. If the industry is eroding, numbers alone can seduce you into a value trap. That is why I've always cared about whether a business will still make sense 10 years from now, not whether it will dominate every headline next quarter, not whether every young investor online will celebrate it this month. 10 years, if you are unwilling to own a stock for 10 years, you should be suspicious of the impulse to own it for 10 minutes. Now, let me show you where this becomes deeply personal for ordinary investors. The market does not just attack your intellect, it attacks your identity. People tell themselves they are long-term investors, then 3 months pass without a dramatic gain and they begin to feel neglected. That is not an investment problem. That is an identity problem. We live in a culture that rewards visible action. Trading feels productive, waiting feels weak, selling feels decisive. Chasing feels brave. Quiet compounding feels boring. But boring is often where the money is. Coca-Cola did not become a lesson in patience because it produced daily thrills. It became a lesson in patience because it kept doing what it was supposed to do. And over time, the economics and the dividends did the heavy lifting. Dividends matter more than many people admit, not because every great investment must be a dividend investment, but because cash return from a durable enterprise proves that earning power is not just a spreadsheet fantasy. A steady and growing dividend can tell you that the business generates real cash, not just narrative momentum. Still, even dividends have traps. A high dividend yield can signal strength. It can also signal a collapsing stock price. A yield that looks irresistible may simply be the market warning you that the distribution is not sustainable. So again, the question is not what is the ratio. The question is what created the ratio. Was the dividend paid consistently for years? Did it grow over time? Is the payout ratio reasonable enough that the company can still reinvest and remain healthy? A business that pays out all it earns or more than it earns may look generous right before it becomes disappointing. This is why serious investing keeps circling back to the same insultingly simple truth. You must read the company as report card, not as an accountant, as an owner. The income statement tells you whether the engine is producing earnings, revenue, operating profit, net profit. If revenue rises while operating profit falls, you should ask why scale is not creating strength. The balance sheet tells you whether the company is carrying itself or being carried by creditors, assets, liabilities, equity, debt ratio. And the cash flow statement tells you whether the profits are arriving in actual cash or mainly in optimistic entries. Operating cash flow is one of the most underappreciated signals in business analysis because profits on paper can still coexist with cash starvation. Companies do not go bankrupt because the spreadsheet said they were charming. They go bankrupt because obligations demand cash. This is where the identity flip has to happen. If you want to invest like the crowd, keep acting like a customer of price. If you want to invest like an owner, start behaving like a private buyer, examining an actual enterprise. A private buyer does not say, the chart broke out, therefore I will buy the whole company. A private buyer says, what does it earn, what does it owe, what protects it, what can destroy it, and what am I paying for it? That is the flip. You are no longer a person visiting the market for emotional stimulation. You are a capital allocator. You are not trying to win the afternoon. You are trying to make one sound decision after another, so that time compounds judgment instead of compounding error. The market makes this difficult because it taxes three emotions again and again: impatience, greed, and fear. Impatience says, if this stock has not rewarded me lately, maybe I was wrong. Greed says, now that the stock is running, I should probably buy even more because success proves I am brilliant. Fear says, it is falling, I need relief, I need out, I need certainty more than I need a thesis. Those three taxes destroy more portfolios than recessions do. The reason is simple. Recessions are occasional, emotional errors are constant. When the pandemic panic hit in 2020 and large portions of the market fell sharply in a short span, many businesses declined in quotation not because their long-term economics had permanently vanished, but because panic had overwhelmed pricing. That kind of moment can be a disaster for spectators and a gift for prepared owners, but only if you have a framework before the decline. You cannot invent courage in the center of a stampede. You must build it beforehand. That is why learning matters. People often say, I read all day. The exact page count is not the point. The point is that conviction is earned before the pressure test, not during it. If you have not done the work, you will borrow conviction from price action. When price turns against you, your conviction evaporates with it. If you have done the work, then volatility does not automatically command your behavior. Now let me give you the blueprint as plainly as I can. First, stop buying because a stock has become socially validated. If your interest begins with a headline, a video recommendation, a friend's excitement, or a recent surge, assume by default that you are late to someone else's party and ask whether you are being invited to celebrate or to pay the bill. Second, force every idea through the quality engine. Is the company producing real earnings? Can it maintain attractive returns on capital without leaning recklessly on debt? Does it have a moat that is behavioral, structural, brand-based, regulatory, or cost-driven? Third, check whether the price offers dignity. Use valuation ratios, but do not use them lazily. Ask whether earnings are recurring. Ask whether book value is economically real. Ask whether the multiple fits the industry, the growth profile, and the durability of the enterprise. Fourth, apply the holdability test. Can you plausibly own this business for 10 years? Will the industry still matter? Will people still want what it sells? Is management behaving like stewards or gamblers? Is the company returning cash sensibly through dividends or reinvestment rather than through theatrical promises? Fifth, keep cash as a strategic asset rather than an embarrassment. Doing nothing is part of investing. Waiting is part of investing. A large cash position is not proof of ignorance if it is held in service of future opportunity. Sixth, when price falls after you buy, do not ask first, how do I feel? Ask what changed if the company deteriorated, if the moat weakened, if the industry turned structurally hostile, then sell and move on. If the business is intact and the market is merely frightened, then your discomfort may be the entry fee for superior long-term results. Seventh, define your sell discipline before euphoria arrives. There are only a few reasons worth taking seriously. The business thesis broke, a clearly better opportunity exists, and capital is constrained, or the stock has become so absurdly overpriced relative to business value that rationality demands action without a prior framework. Selling becomes mood-based mood. Base selling is just another form of speculation, and now the final threshold: you have to decide what game you are playing. If you want excitement, the market will always offer it. It will offer speed, noise, status, and the delicious illusion that movement equals progress. It will let you feel informed every hour and foolish every quarter. If you want wealth, then you need a different contract with yourself. You need to agree that owning a business is more important than reacting to a chart. You need to agree that being early and lonely can be safer than being late and socially confirmed. You need to agree that a fair price for a strong business beats a thrilling story for a weak one. You need to agree that patience is not passive. It is active restraint in service of compounding. Most people never sign that contract. They want the language of long-term investing and the sensations of short-term speculation at the same time. They want to be told they are disciplined while still being entertained. The market usually punishes that contradiction. So here is the mirror I want to leave you with. 10 years from now, when you look back at the stocks you bought, what will you be able to say? Will you say, I chased what looked alive and sold what felt uncomfortable? Will you say, I followed stories I had not earned the right to believe? Will you say, I confused news with insight, price with value, activity with intelligence? Or will you say something rarer and far more profitable? I studied actual businesses. I waited when there was nothing to do. I bought understandable companies at sensible prices. I let time work on real earning power. I refused to let impatience, greed, and fear make decisions that belong to analysis. That is the threshold. Cross it, and investing stops feeling like a carnival and starts feeling like stewardship. Ignore it, and you may spend the next decade living the same miserable script that traps so many market participants, buying attention, renting conviction, selling pain, and wondering why wealth never seems to stay. I have never believed you need to be extraordinary to do well in markets. You need to be sane when others are excited, rational when others are terrified, and humble enough to admit that a stock is not a lottery ticket but a piece of a business. That sounds simple. It is simple. But simple is not the same as easy. Easy is following the crowd. Simple is doing the work. Easy is asking what went up. Simple is asking what is worth owning. Easy is panicking with everyone else. Simple is remembering that markets come down through the window while good businesses. If truly good, keep finding ways to earn money long after the panic has moved on. So choose now. Do you want a life of reacting to prices, or do you want the slower, quieter, far more powerful life of allocating capital with conviction? The first path gives you stimulation. The second path can give you freedom. The market will test whichever answer you choose.